Okay. All right, good. Accept that. And if you had downloaded the chapter 14 slides at an earlier time than today, you may want to get that, throw the old one away and get this new one up because I did make some changes today. So this is the latest, but let me put it into slideshow mode and hope and pray that it doesn't do that snafu that we've become annoyingly accustomed to. Um, let's see. Yeah, it's going to do it. So I will have to go through the ritual. All right. It again. Power cords back in. Yeah. Sorry, guys. I don't know why I have to always go through this. Okay, and of course I forgot the clicker. So I guess I can take some consolation in that my forgetfulness is consistent anyway. So, okay. All right, let's go ahead then. And sorry, now I'm rolling over on my cords. Okay. All right, good. So let's go ahead and let's take a look at chapter 14. And we're turning our attention now to not-for-profit organizations. Okay, so we sort of have moved on beyond state and local government accounting now, and now we're talking about not-for-profit organizations, and we're primarily talking about private sector not-for-profit organizations. And you can see, and I'm sure you know, that these are very significant in the United States, and some of these not-for-profits may be operated by governments, as you can see in the last couple of bullets. And then governments may fund not-for-profits that provide various services. And I'm pretty sure I know the answer to this question, but let me ask, does the city do work with not-for-profit organizations in providing services, I don't know, to citizens of the city and county? Any input on how that might influence our discussion?
Oh, yep, this is Carmen. Yes, we pay not-for-profits to provide services um, for the city. Yeah, which is for the benefit, ultimately for the benefit of the citizens.
Right. Um, Carmen, I had sent you an email. You may have not seen it, but
Oh, yeah, I responded to it, but probably too late for you to see it back.
well,
I
yeah,
put,
that's okay.
yeah,
Because
but I
we
did
can.
put one in there that I don't actually work with the nonprofits, but actually Min gave me a good idea about one of them that she was kind of peripherally aware of. I don't think probably none of us on this call, maybe there's somebody on this call. I don't know if one of the fund accountants ever like actually talks to the nonprofits, but we put ONLOK, ONLOK down as one of our service providers. I'm not sure if that's what you were looking for, like a service provider that we pay for services.
All I'm trying to do is have a relevant example where I can we're going to talk generically here, theoretically here, but it'd be nice if we had an actual example, one that might be relevant to some, connection to the city.
Mhm.
Is it ONLOCK?
And ON and then space LOK.
ON space LOK. Okay.
Yeah, and then I
Um,
think it had another services afterwards. I don't know if you're probably not able to pull it up while you're in class, but I'll pull mine up. Let's see, it had something day services, ONLOK day services, I think was the whole name when we make the payments to them. I looked it up in our system, and that's how the payments actually go out to them.
okay. I won't do it tonight. I think next time, and that's fine because we've got a fair amount of stuff to go through tonight anyway, and so we'll get a general idea of the structure and format and some of the revenue and expense recognition issues associated with not-for-profits. And then we can, see to what extent ONLOK sort of is giving us a good example of some of the things that we'll learn tonight. So that's the approach we'll take. So.
Okay, yeah, and others on the call may know more, other nonprofits too, that if anyone wants to pipe up on one of their favorites, that's fine too.
Okay.
Thank you.
Okay. Well, if y'all think of something as we're going along, just jump on in.
Okay,
Okay, good.
thank you.
So let's take a look and major categories, if you will, industries of not-for-profit organizations, hospitals, nursing homes, hospice being discussed here, educational institutions, colleges and universities. Golden Gate would certainly qualify as one of those. And then you take a look, and I think the broadest or the category that has the most not-for-profits fitting under this heading would be voluntary health and welfare organizations. And you can see some of the common ones or well-known ones listed. And then I would think this ONLOK would probably fall under this category of a voluntary health and welfare organization. Although I'll be able to kind of more precisely target where they would belong under these categories. Not that it's that big of a deal. Once I get a chance to take a look and read up on them a little bit. Okay. All right, good. So we come over and when we're following the accounting standards for not-for-profits, we're going to see here in a couple seconds, they were following Financial Accounting Standards Board FASB requirements. Now, I'm sure you know, FASB sets the accounting standards for for-profit, private sector for-profit entities, but they also set the accounting standards for private sector not-for-profit organizations. And one of the major, I guess maybe it's a good thing. I know that for my students that are just learning governmental accounting, it's a good thing. We're going to be following full accrual accounting, and we're going to be following the accounting standards codification promulgated by the FASB. And what FASB has done is they have codified all not-for-profit guidance standards under section 958 of the codification. And so anytime you're looking for something for not-for-profit, you start out with the first three numbers being 958, and that's the way FASB has organized those standards. So we're not following GASB anymore. we're back to or reacquainting you maybe with the Financial Accounting Standards Board standards. Now, not terribly important, but I thought it was worth taking a look that what FASB does is when they put together their standards, okay, they have, sorry guys, I'm gonna go ahead
Công nhận thì có thì xin đó.
and mute somebody, yeah. I don't think they realize.
Có gì hả? Nên tụi con nghe, nên sẽ hả?你講個意見都點解？你學人哋你反 up and back 啊，你反咗 review 啊？
Okay, I'm trying to mute that and not getting lucky here, okay? Why is it not letting me mute? Okay, I guess I have to do it on the main machine. 1 second, guys. I don't know that we want all that conversation coming out over the meeting here. Okay, I think we're good. Okay, good. Sometimes folks don't realize they have their mic open, and I don't want to have a discussion of some personal issues coming out over our meeting here. Okay. Okay, good. So when you take a look, really. You could see that what the FASB does is when they put together their standards, they put them together by major topics. Okay, so for example, if you were looking up something dealing with the balance sheet for any organization, you would go for a for-profit organization, you would go to topic 210. If you're looking up something for the income statement, 225. You're looking up something for the statement of cash flows, you'd look up topic 230. And so FASB has continued to use that approach, but then when they get into industry specific, in this case, not for profit, they put another prefix in front of that 958. So anytime you're looking up something for not for profit, you know that you're in the right place if you have the first three numbers in that citation in the codification where you're looking is 958. Carmen, do you guys have the FASB codification around, or is that something you have access to?
We don't have it like laying around, but if we need to, we have a research tool that we use, and we can look up anything about anything actually related to accounting. So if we need to look up anything related to FASB, but we don't really do anything with FASB generally.
Right.
So yeah, it would
Okay.
only be if we
Okay.
needed to for some
Well,
reason.
as you
Yeah.
move forward, if you do find something with a not-for-profit and you're trying to find something about
Right.
standards anyway, that's how you would find it using the FASB codification. Okay, good. Now, when we look, and this slide's a little bit busy, a little bit small. Let me see if I can have any luck making it bigger. Okay, there we go. Okay, I'll make that a little bigger so it's still busy, but at least it's not as small. When we're looking at the statement of financial position, okay, we have our assets, we have our liabilities, and instead of having fund balance or, we are used to having net position that we were talking about with the government-wide statements for government. Instead, we call that equity portion, if you will, net assets. Now, the difference between our assets and liabilities would be net assets. And when we look at those, we see that they are going to be listed in whether they are with or without donor restrictions. Now, in order for something to be, let's go to the second one here, this 3.3.2, net assets with donor restrictions. In order for something to be restricted, it has to be restricted externally. In other words, some entity outside of the not-for-profits board of directors, outside of the not-for-profits management has designated what those funds are to be used for. And when we look at those, you can see the various types of restrictions that we run into, and we can see that it could be for support of a particular operating activity, for example, a particular program, okay? we can see that it could be a stipulation as to a specific term that we have to hold an investment. So they may say, hey, here's a certificate of deposit, but it has to be held until maturity. Investment for use in a specific period. I'm giving you the money now, but I want you to use it this year, or maybe I want you to use it next year. It could be for purpose of acquisition for some sort of fixed asset, long-term asset. Sometimes the donor will say, hey, these funds are to be used to build a building and I want my name on the building or something of that manner. Okay. Now, when you look at these ones here in yellow, okay, when you really think about them, they tend to be temporary in nature. Okay. By that, when I say temporary in nature, what I really mean is that the not-for-profit can satisfy the donor's stipulations by doing what the donor said. Use it for program A, program B, hold the CD to maturity, whatever it is. So they tend to be temporary. Before, FASB used to literally call these out as temporary restricted net assets. And then for things that had more of a permanent nature, they used to go ahead and break those out as net assets permanently restricted. They don't do that anymore. Now what they do is they just say, hey, they're either restricted, they either have donor restriction or they do not have donor restriction. But when you look at these things that I'm trying to use the green on here, okay? Assets that are used for a specific purpose and not sold. You have to use them in the operation of the not-for-profit, or donor restricted endowments that are perpetual in nature. Usually they say, hey, maintain the principal or the corpus, and then you can use the interest, and they maybe will not put any sort of donor imposed restriction on the use of the interest. Or they may put of a temporary nature, a donor imposed restriction. The money is to be used to fund a daycare center or whatever it is. But those ones that I have highlighted there in green tend to be more of a permanent nature. Okay, Microsoft doesn't have the best way of changing the color of the pen in their presentations, but these tend to be not temporary, but tend to be more of a permanent nature. I'm just going to put perm. Okay. Okay, good. Question on that. Okay. The statement of financial position is what we use to refer to what we know as the balance sheet. Assets equal liabilities plus, not stockholders' equity anymore, not fund balance, not net position. Now we call it net assets. Okay. Okay, good. Now you come over and I give you an example of a statement of financial position. And by the way, I want to say this example is lifted straight from the examples that FASB gives us in the codification. Okay, so you can see our assets, both current and non-current, guys, full accrual accounting, our liabilities, current and non-current, and then as we saw, our net assets can be without donor restriction or with donor restriction, and then we total those two numbers up to give us the total net assets, and of course the balance sheet must balance, right? That's why it's called a balance sheet, okay? And you take a look and you can see some numbers here for year 2 that show the amount of the net assets without donor restriction and with donor restriction, 92,600, without 193,490. Now notice that that presentation doesn't really give you any sort of understanding is, well, what is the nature? Is it some of those that are maybe more temporary, like a program restriction or a time restriction? Are there something that maybe is a little more permanent in nature, for example, held for an endowment, or the asset must be maintained, etc.? And so FASB requires certain disclosures here, and you can see guys here, you probably are recognizing that number 193,490. That was the total of the with donor imposed restrictions. And then there's a disclosure that is often in the footnotes that would show you the nature of those donor imposed restrictions. And you can see by looking there whether they might be maybe more permanent in nature, temporary in nature, etc. So the nature of the restrictions isn't explicitly displayed on the statement of net assets. But if you wanted to look a little bit further, statement of financial position, if you wanted to look a little bit further and see, well, what is the nature of those restrictions, you would find some disclosure there. Now, when you go back to the slide we initially were talking about with and without donor restrictions, again, only donors can impose a restriction. So if a donor's not imposed a restriction, those net assets are considered without donor restriction. Okay, makes sense. Sometimes, though, the board may designate funds for some purpose. Now, those funds are still considered without donor restriction because, again, only donors can place a restriction on the use of a particular resource. But the board may decide to designate something. And so what they would do, and you can see here that our total without donor restriction is 92,600, but FASB has said, hey, you probably want to disclose, even though those are all considered without donor restriction, if the board has imposed some sort of desire for the use of those unrestricted, without donor restricted net assets, then you're going to want to disclose that. And so that's what this example did. Question about the statement of net position, the balance sheet. Okay, good. Let's go ahead then and look at the statement of activities, which is like the income statement. And on our statement of activities, which is like our income statement, we're going to show the change in the total net assets. Change in total net assets is sort of like saying net income, right? Think about it. If we have our fund balance, and the difference between our beginning fund balance and our ending fund balance is the change. I'm a little unclear why we keep getting ambient noise. Okay. Okay, good. And so if you take a look, you can see the change in total net assets. That's like the change in fund balance. That's like net income, right? But not only do we have to show it for the total net assets, but also by category of net assets. So we have to show it for our change in our net assets with and without donor imposed restrictions, okay? Now, we're also going to have to show a section that shows that as we satisfy a restriction, remember we had those that are sort of more temporary in nature, we use the money for the purposes imposed by the donor, we use it for a particular program, whatever it is, then we will show a reclassification of those resources that have been used coming out of with donor imposed restriction and going into the without donor imposed restriction. And then all expenses are reported as in the without donor imposed restriction column. Okay. Now, understanding the mechanics of that statement of activities. Okay. I say unrestricted net assets. They used to be called unrestricted, but it'd be net assets without donor imposed restriction. But taking a look and understanding the mechanics of that statement of activities tends to be an area that we want to massage a little bit, make sure that we're fully understanding what that presentation looks like. Okay, so what happens? We have our net assets with and without donor restrictions, and when contributions come in, they come in either with or without donor imposed restrictions. Okay, and again, it could be for a particular purpose. in which the not-for-profit can satisfy that, that's going to be more temporary in nature. If it's more permanent in nature, then we're going to show those amounts coming in as with donor imposed restriction, and they will never reclass out of the without with donor restriction into the without, because there is no way that the not-for-profit can ever unrestrict those because the donor has placed some sort of permanent restriction on those. Okay. But what I did here is I kind of came up with this silly little example, and I kind of went ahead and said, okay, I like animals and dogs and stuff. So this was kind of fun for me to think about. Okay, let's say we had a not-for-profit, and the not-for-profit's whole function was to find stray dogs, stray cats, okay, and find them a home, place them with a home, sort of like a no-kill shelter type of situation. There are many, many organizations like this, as I'm sure you're aware, but I called mine Save the Canines, and I decided to have a funny way of spelling out canines, right? Because since we're accountants and whatnot. And in this example, I do sort of the unrealistic way of looking at it in isolation of amounts coming in and then being spent in different years, because I want to isolate the way the contributions coming in would look versus the spending of the contribution. So in this little example, I sit here and I say, look, somebody gave money to Save the Canines and called out a particular program that it's to be used for. It's to be used for the program where we'll spend money caring for the animal, getting them ready to take them for home. So we're going to buy a bunch of, dog shampoo and clippers and that kind of stuff, whatever it is. Okay. Now, what happens? Since the donor said that we are to use these funds for a specific purpose, then on our statement of activities, like our income statement, sort of up where the revenues would be, but we don't call it revenue because someone's giving us this out of the kindness of their heart. So we call it what? Contribution. We save the word revenue for what? For when the not-for-profit does something to actually earn that contribution. They provide a service or something of that nature. Okay, so we're not going to call it revenue here. We're going to call it contribution. Okay, so when we take a look here at this contribution, somebody gave us 10,000 and said use it for this fluffy program where you're trying to get the dog looking cute so somebody will take it home, right? Now, in this first year, we raised $10,000, and it turns out that we don't spend any of that money. Okay, so we have a contribution coming in, we have no expenses, and if we have the contribution coming in and we have absolutely no expenses, okay, then what happens? Our net assets with donor imposed restriction would increase 10,000. That would be our change in net assets. That's like our income number. And we wouldn't have any in this example that came in without donor restriction. So that would be zero. And then our beginning balance, assuming we just started this not-for-profit, is zero. And so the ending balance is 10,000. And that's how that statement of activities would look for that year. I didn't show the total column, guys, but there would be an expectation that the entity would add the two columns together and put a total there, but I didn't feel like putting that total in there. We'll take a look at a more complicated version of this in a minute. You'll see how they report the total. Okay, now you come over, and for year two now, the not-for-profit doesn't raise any money, so contributions are zero across the board, but they use $6,000 of the funds that were received in year one that the donor said needs to be used for the fluffy program, whatever it is. In year two, they use 6,000 of that 10,000 that came in. So this is that reclassification adjustment in which we will show amounts coming out of the with donor imposed restriction and coming into the without donor imposed restriction. And then you can see the expense of that $6,000 being listed under the without donor imposed restriction. Now the change is zero. It went up by the reclassification and came down by the expense. And so again, beginning balance for year two, last year's ending balance was zero. So year two's ending balance is zero. The beginning balance for The with donor imposed restriction was last year's ending balance of 10. And since it decreased 6, now the ending balance is 4. And again, we'd report a total column over there. So that's the way the mechanics of that statement of activity. So if you're looking at one, you're seeing those reclassifications, that's meaning that the not-for-profit had satisfied some donor-imposed restriction, and that donor-imposed restriction was probably of more of a temporary nature. Question. Okay, now when you look at the Gatsby's version, sorry guys, I'm getting glare on my machine, and it's just a real burden to kind of see it. So let me see if I can flip this the other way. Let's see if that lessens the glare. Never been good at the mechanics of blinds. Yeah, that's much better. It's a little better anyway. Okay. All right, good. Now you start to take a look, and this is from the FASB codification. And let's take a look at this. And yeah, more numbers, a little more busy than what I had with the little Save the Canines thing. But I think you're going to see that the mechanics are very much in line with what we just looked at, right? Okay, so you take a look, and we have our contributions, and they come in what, either with or without donor imposed restrictions. Really? Are you still seeing my screen? Let's see.
Yes.
Yeah, okay. They come in either with, your screen sharing is paused. So I'm telling it I want to share. I don't want to pause. Mm-hmm. Let me stop share and see if I can start it again. Okay, good. Okay, so you can see the without donor restrictions and then the with donor restrictions, just like we saw in the little Save the Canine example. Now we have contributions, and yeah, some can come in with and some can come in without donor imposed restrictions. Sometimes donors say not for profit. You know what to do with the funds. Use it however you see fit. And look, they can't be taking exorbitant vacations or something ridiculous like that within the charter of the not-for-profit. But yeah, sometimes amounts will come in that way. Notice here, guys, that fees, if the not-for-profit charges a fee for a service, FASB has said that's automatically considered without donor imposed restrictions. So if, for example, the not-for-profit decided to start doing, say, doggy grooming, and we're raising fees to do the doggy grooming, and then the donor, the customer at that point said, by the way, I want this money that I'm giving you for my doggy grooming to be used for the Fluffy program. Sorry, we don't do that. If we're providing you a service, it is automatically considered without a donor imposed restriction. Investments, okay? A donor could give us, say, a stock. And they could say, you got to hold the stock forever. Okay, well, when the value of that stock comes in, that would be in the what? With donor imposed restriction, because that money came in and they gave it to us, and we are never going to see it reclassed out because we have to hold the stock forever. And whatever the market value of that stock is when it came in, that would be shown under the with donor restriction column. Now, let's say they say dividends that may be paid off of this stock are to be used for a particular program. Well, if that stock paid a dividend, then we would go ahead and we would report that dividend income under the with donor imposed restriction, because they said the dividends have to be used for a program. And then when those dividends were used for that program, we would see the reclass out. They could restrict the stock, say permanently, and then say, hey, any dividends you can use however you see fit within the charter of the not-for-profit, of course. And then when those dividends come in as income, they would be reported under the without donor imposed restriction column. So that's why you see amounts coming in under both columns there. Okay. Now, let's go ahead and turn our attention a little bit to the reclass section. Okay. And when you look at this reclass section, guys, notice, just like we saw in our little Save the Canines example, okay, you have what? You have amounts coming out of the with donor imposed restriction column and into the without donor imposed restriction. That's telling you that the not-for-profit satisfied donors restrictions that period. That's the amounts anyway, that they have met donor restrictions for those periods and therefore classed them out of the with donor restriction and into the without donor imposed restriction. Now, as we saw with Save the Canines here, all expenses are automatically considered what? Automatically considered without donor imposed restriction. Think of the without donor imposed restriction expense as a plug that we pull out of the bottom part of this statement of activities so that what amounts can be reclassed, and that's how they basically make it out of net assets as they decrease our change in net assets for the period. Okay, so we have our total expenses down here, and then you can see that we have our change in net assets, the beginning of the year net assets, and the end of the year net assets. And notice here, guys, you can remember that number that I had highlighted before. That's the ending balance that's reported on this statement of net position, the 92,600. Now, when you take a look, you can see that there is this one little sort of situation where we have an amount being subtracted out of the with donor restrictions, and that must be some sort of permanently restricted asset that lost some value. And so we took that out of the permanently restricted without donor imposed restriction, I should say, column there, but that's a relatively small amount. Questions on the mechanics of the statement of activities? Okay, good. Now, we also want to see how expenses are categorized on the statement of activities, okay? And so basically there's two large groupings. We have program services, which is what I'm saying things not-for-profits do. And then we have support expenses, which I'm saying these are things that not-for-profits do to survive, okay? So let's just take a look back first at the statement of activities here, and you can see the programs here. Okay, program alpha, beta, gamma, not very creative, but you know, Save the Canines, we might have the fluffy program listed here. And then we have what? We have more support services listed here, even though they didn't call it out as such. Okay, but these would be more considered support, okay, and that without the appropriate management, without fundraising, not-for-profits aren't going to survive very long, right? And so that's why I say, you know, that this is support is basically what the not-for-profit does to survive. And you come over and they give you some more examples. I took some of this from a CPE class I used to teach for Becker. And so I thought it was okay, since I helped develop this material, that I would go ahead and lift some of it from them. And so you can see some of the examples of support versus program expenses. Okay. Now, you could also have combined cost. And with combined cost, we have to come up with a rational way to allocate between the support function and the program function. For example, let's say we hold a class and we say that we're going to teach people doggy grooming because we've stipulated that the reason people get rid of the animal for our little Save the Canines objectives is because they don't know how to care for the animal. So we sit here and we say, okay, we're going to have a education program and we're going to have a doggy grooming class. And we're going to charge everybody $1,000 to come to this class. And somebody looks and says, who in their right mind would pay $1,000 for a doggy grooming class? And we say, well, we're putting in there fundraising components. So yeah, maybe the market value of that cost is $100. We're charging $1,000 for it. Okay. And we're going to spend $50,000 on the well, that'd be a lot. We're going to spend $5,000 putting this class on. Okay, well, how much of that 5,000 is a program expense versus a support fundraising expense? And a rational way to allocate that would be to say, well, if the market value of the class was 100, you charged 1,000, 90% of that 500 or 5,000, 4,500 would be considered fundraising. And the remaining 500 in that example would be considered a program expense and you would allocate it accordingly. Okay. Okay, good. Now we take a look and the not-for-profit has to provide a disclosure. It used to be literally a statement. Now not-for-profits put it in disclosure, and I'm not entirely happy with the way I see some not-for-profits disclose this. I don't know why FASB, frankly, backed off the requirement of making not-for-profits put it in a statement format, because in my mind, this statement is one of the more useful statements that, and it's no longer a statement, one of the more useful sets of information that FASB requires not-for-profits to use, to provide. I had a colleague from the Government Accountability Office. He's passed now, but he was working, had left the GAO and decided to go work for the city of San Jose. And the city of San Jose had contracted with a not-for-profit to provide some services. And he says, hey, can you come down and take a look at the financial statements for this not-for-profit and kind of walk us through what we ought to be looking at? I says, you buy me lunch? He says, yeah. So I go down and we do that. And I says, okay, let me see. And the first thing I turn to is this statement of activity, statement of functional expenses, which was still called a statement at that time. And it allows us to see precisely what sort of functions, type of activities the not-for-profits are spending their money on. And when we took a look, we saw that the not-for-profit was spending more money on fundraising than they had in contributions. And when we, not more money on fundraising they had in contributions, but more money on consulting services than they were raising in the contributions. And so it was like, well, what are they doing? The city is funding a fundraising effort in which the amount that comes in from that fundraising is less than what the entity is spending on it. Not a good thing. And so that was sort of a big finding just by looking at that statement of functional expenses, which is no longer a statement. But let's just take a look, and you can see the statement of activities here. And let's just pick up a program here, this particular program, program alpha, whatever it is, and you can see that 13,926. Now, when you look at that, you're like, Okay, but what are they spending that on? Okay, and so you come over and you can see that 13,926 for that program. Okay, and you can start to take a look and see that, hey, they're spending quite a bit on salaries and benefits. And if they had in services and fees, here we go, services and professional fees. Okay, and you start to take a look and you can see services and professional fees. They spent 160 here. And so it allows you to see what the programs are spending their money on. Okay. Mostly salaries and benefits here. Now, when in this example, but when you look over here, services and professional fees, you can see what they're spending on fundraising. And again, this not-for-profit was spending more money on the fundraising than they were raising in funds from this particular activity. And so, for most entities, that should be a multiple in the 6 7s, not, in underwater. Okay, so that might be something that we might want to look at in a real case scenario, not tonight, but maybe if we find a not-for-profit that's relevant. I could also show you a not-for-profit that I've looked at, not that one that I was talking about, but one that I've looked at for some of my classes if you want to do that. So let's see how we would do that. But that's why I think this, what used to be called the statement of functional expenses, is a very useful piece of information. Okay. Question. Okay, good. So you can see how those numbers tie together. Okay, good. Let's come over and let's take a look at the statement of cash flows. And notice here, guys, we can use the direct or the indirect method. I don't know why FASB is saying use the direct or indirect method. I think that the direct method would be more useful. And I don't know that not-for-profits have any trade secrets or competitive secrets that they want to try to, shield disclosure of. And so I don't know. You remember we said that for our proprietary funds, for our government, state and local governments, they must use the direct method. And remember that we also said that we reconcile not from net income, but to operating income to determine the cash provided by operations. So I don't know why the FASB has sort of backed off on some of the general things that we've seen for government, and or why they are sticking to a for-profit kind of requirements for the statement of cash flows when there's a very good example of what public service type organizations ought to be providing under the GASB requirements. Anyway, that's my little speech. They don't ask me, but you take a look and you can see that unrestricted contributions will be reported as operating activities. Restricted contributions for long-term purposes fall under financing activity. Investments in equipment are investing activity, nothing surprising. And if there is a non-cash gift, like a contribution of some materials or something, that's obviously not going to affect cash, but it would need a specific disclosure in the financial statements in a separate section where we talk about the statement of cash flows. Okay, so you take a look and notice here, guys, they are using the indirect approach in this example. You have the change in net assets. And by the way, we sit here and we do the total change in net assets. So we go by the total. We don't do it by category. We pick up the total of the without and with donor restriction totals. And that's what we start with in the indirect method here. Okay, and then we go and we reconcile from the change in net assets to our cash provided or used for operations by the year. We have an operating, we have investing, we have financing. Now, an annoying feature here is because we're starting with the overall change, and the overall change is a combination of the with and without donor imposed restriction. If there is a contribution that comes in and it's with a donor imposed restriction, well, we saw that that's supposed to be down in the financing section when that comes in. And, we saw in the previous slide, but we started with the total of the with and without. So we end up having to do a weird maneuver where we show an amount, this interest and dividends, I guess, had some sort of a donor imposed restriction, long-term purpose donor imposed restriction. So we have to take it out here and show it coming in here because we're supposed to report those things in the not operating, but the financing section. But because we combined the with and without donor restriction amounts to come up with the change in net assets in total, we get stuck doing weird things like this. Whereas if they had taken a different approach, they wouldn't have quite run into that problem. And so it gets a little complex. I think maybe unnecessarily. I think the FASB could take another look at that and make that a little simpler to understand what's going on when you see stuff like that happening. Okay. Okay, good. So we've seen now the structure of the financial statements. And so what we're going to do now is dig a little deeper, talk about some revenue recognition considerations, contribution recognition considerations, expense recognition considerations, and then we're going to get into some more minute, specific accounting considerations for not-for-profits, okay? So when revenues come in, as we've seen, they come in contributions, contribution revenue, sometimes synonymously used. We can see that they can increase either are with donor imposed or without donor imposed restrictions. Now, sometimes we'll have revenues that will come in, not contributions, but revenues will come in because we provided some sort of service, and you can see the different types of services that might be provided by the not-for-profit. Those are automatically considered to be without donor imposed restriction. Those are always considered without donor imposed restriction. You saw fees, and you saw that coming in under the without donor imposed restriction on our little statement of activities example that I've given you from the FASB disclosures. Support contributions, okay, are when somebody gives us money out of the kindness of their heart. Now, how do we know if we have earned that non-exchange revenue? Exchange means, hey, I paid and I got something. So our revenues would be considered exchange. Non-exchange is when somebody gives me something and they just give it to me because they're required to by law, and that would have been the case with the taxes and the government. Remember, we had our different categories of non-exchange, or in the case of a not-for-profit, just because somebody likes the mission of the not-for-profit, they give us that money out of the kindness of their heart. So if somebody turns around and says, hey, I promise I'm going to give you $10,000, okay, we would debit pledges receivable, credit contribution, 10,000, okay? And then later on, when that money comes in, I'm seeing my journal entry is not very good. Yeah, there it is. It's okay. It's all there. Okay, that journal entry right there. Debit pledges receivable, 10,000, credit contribution, 10,000. And we can take that at the time that the promise is made. Okay, so someone promises unconditionally they're going to give us that 10,000. You can take that as a revenue at the time, as a contribution revenue at the time the promise is made. If they give us cash, okay, then of course you debit the cash, and that's the journal entry that's spilling off the page there. And then you can credit, I can't erase that, guys, but I'm trying to credit contribution there, 10,000. And you can do that when the cash is received. Okay. Now, there could be pledges that are unconditional, and you report those as a contribution at the time that the pledge is received. But if it's conditional, somebody says, well, I'm going to give you 10,000, but I first want to see that you have found a home for 100 dogs or something. I can't recognize that revenue until I have found a home for 100 dogs. And sometimes, FASB will say, well, the condition is substantially met. If you found a home for 9 dogs and one of the dogs was going to have pups in a couple of days, I think you've substantially met that. Okay, so they don't get too crazy on that, but you pretty much have to have met that. And at that time, when the condition is satisfied, then the not-for-profit can recognize the revenue. Okay, now when these amounts come in, guys, they can still come into the with or without donor imposed restrictions. So someone can give me an unconditional pledge and say, but it has to be used for the Fluffy program. So it's unconditional. I can recognize it when the pledge is made. I debit cash. Our debit pledge is receivable, I guess, and I credit contribution, but that would be listed under the with donor imposed restriction column on the statement of activities. Conversely, someone can give me a conditional pledge. I can't record it until the conditions are substantially met. But if they haven't restricted how I use those funds, right? When the condition is substantially met, I debit pledges receivable, I credit contribution at that time, and that would be reported under the without donor imposed restriction, because the donor said, hey, when you meet the conditions, you can use it however you want. And we've met the condition, so we can recognize the revenue, we can report it on the statement of activities, and it can be considered without a donor imposed restriction. Okay. Question. Okay, good. Now, if an unconditional pledge is received in less than a year, we have to adjust for any uncollectible amounts. Yes, sometimes people say, hey, I'm going to give you a contribution, and then they don't send us a contribution, unfortunately, right? It happens, okay? So what happens? We debit the pledges receivable for the gross amount they've pledged, considering it's unconditional. We credit contribution, but if our experience shows us that, say, I guess this is 10% of our pledges are not received, then we'd have to set up an allowance for the uncollectible, and that allowance would be a direct subtract to our pledges receivable. Okay. Now, if you have long-term unconditional pledge again, and they say, hey, I'm going to give you $500, but I'm not going to give it to you until next year. Okay. Then what? Well, we would have to figure out, well, what is the present value of that $500 in year one, let's say, when they make the pledge. Debit the pledges receivable for the present value, credit the contribution for the present value, and I'm just making up, let's say the present value is $475. And then later, the next year, whatever, when the donor gives me that $500, of course, I debit the cash for $500, I credit the pledge receivable for $475, and the additional $25 is taken as a contribution in year 2. So we don't call it interest revenue or anything like that. We just simply call it a contribution in the second year when we actually receive that full 500. Question. Okay. Donated materials. Sometimes rather than give us money, people give us stuff. I don't know. Maybe a Petco or whatever decides to give Save the Canines a bunch of dog food. Well, if that's the case, then we would go ahead and debit our materials inventory 10,000 and credit a contribution for $10,000 because they gave us some supplies that we can use. Okay. If somebody donates services, okay, we need to look to the nature of that service to see if we should recognize it on the financial statements, okay? So in order for something to be recognized on the financial statements, it has to require a specialized skill. It has to otherwise be needed by the not-for-profit, and it has to be measured easily. And so I gave you this little mnemonic down here, SOME, some, so you remember what the requirements are. There's only 3 requirements: specialized skill, otherwise needed, and measured easily. But I broke up the measured and easily into 2 separate words so that it spells some. And if it does, if it meets all of those requirements, then you would have to go ahead and recognize that as a contribution. The other potential is if it's going to enhance a building or a piece of property or something, then yes, you should recognize the value of that service being provided to the not-for-profit. So if it's, a building, debit building, credit contribution. If, say, a nurse is providing a service, nurse is obviously specialized skill, otherwise needed. Yeah, the hospital, let's say, needs nurses and measure easily. What do we pay the person when we pay them and when they're not volunteering their time? So that would meet all those criteria. And so you would recognize the salary expense and the contribution for that kind of a thing. Okay. Be careful with this if you were to ever question whether something is a professional service. I see CPA exam questions in which the examiners will say, well, it was secretarial services that were donated. And, some of my students will say, well, that's not professional. Yes, it is. Okay. Things that are not professional, things like, and a good example would be an organization like Habitat for Humanity, where they'll have, say, a CPA firm will, put together their employees to come and help, clear weeds away from a site where they're going to be building some, low-income opportunity type housing or something. That would be considered not requiring a specialized skill because the person providing the service, okay, that's not their area of specialization. Or they may, there's a program called the Self-Help Opportunity Program that the federal government used to run. I don't know if they still have it, but back in the day, they had a program like that. And they used to set up that everyone in that emerging neighborhood that was being built had to help with the other one's home. So I had to come help build your house. You had to come build my house. And the idea there was they would build stronger communities as a longer term outcome as a result of the program that the federal government was funding to a large extent. And so what they would do, though, I don't want you doing the wiring in my house if you're not an electrician, right? And you don't want me doing the wiring in your house. I'm not an electrician. So for that, they would have specialized individuals doing that. But for things like hanging sheetrock, that was something that with a little bit of training, a guy like me who's an accountant that's helping with your house could probably figure out how to hang sheetrock after a while, though you probably don't even want me hanging sheetrock in your house, quite frankly. But anyway, so they would have a professional that would help teach and supervise the hanging of the sheetrock, let's say, and that person's salary would be, or whatever fee you're paying them, that would be recognized, whereas the time of the neighbors, doing that work, that wouldn't be recognized because that's not their specialized skill. So that's sort of the way that parses out. Okay, good. Now, non-cash contributions are called gifts in kind, and they would be valued at whatever their market value was at the time of the donation. So let's say somebody gives us tickets to the theater or something. Hey, go see Handel's Messiah or something, and it's $100 ticket, whatever, and they say, we're going to donate that to the not-for-profit, and not-for-profit, you can auction it off or something if you want. Okay, so what happens? Not-for-profit gets a lot of stuff like this, and so maybe one day they hold a silent auction or something. Okay, so when those tickets to, you know, the symphony come in, we would debit tickets and credit contribution. And I use Handel's Messiah because every year I have to go see Handel's Messiah. And this last year was one of the first times they actually had a countertenor. And countertenor is my favorite voice in the opera, and they actually had a countertenor this year, and it was great. So that's why I used the Handel's Messiah example. I'm not a terribly religious guy, but I like Handel. So what happens? We go ahead and I guess I have to tell this story. So I live in Hayward, and somebody broke into my mailbox and took my tickets. And so when I'm not getting my tickets, and I said, well, someone broke into my mailbox and I may think they got my symphony ticket. So I called the symphony and I says, hey, you know, somebody took my tickets. Can you issue me some new ones? And they say, oh yeah, sure, absolutely, sir. You know, come to the will call window and we'll have a new fresh set of tickets for you. And I say, oh, great. Because I can't wait to see who's sitting in those seats when I get in there to say, sir, you know, we don't want to trouble. They're going to void the old tickets and only the new ones will work. So they were kind of like, keep Hayward in Hayward, dude. We don't want, you know, Hayward scene happening here in Davies Symphony Hall. So anyway, but what happens when those are donated to the not-for-profit, we put them in at whatever the market value was. We debit tickets, we credit contribution. Okay. Now, coming down to number 2 here, let's say we auction those off, and let's say we do a silent auction, and you know, the people that are bidding on those things can see that the market value is $100, but you know, sometimes you maybe serve a little wine at these silent auctions, and people are feeling good about the mission of the not-for-profit, and they're having a little fun with their friend, and they start to bid this amount up over what its market value was. So ultimately, they are auctioned off at $150. At the time the person pays $150, then they go ahead and they debit cash for $150, credit the tickets for $100, and that additional $50 in that example would be treated as a contribution. Okay. Now I had a student say, well, what if it sells for less than what the market value was? Could happen. Maybe it's some sports team that's not doing too well and nobody cares about going to the last couple of games because they're going to lose and there's a meaningless game and no one wants to pay the full $100. Well, if that's the case, then you would credit the tickets for the full 100, of course, to take them off the books. You would debit the cash for, say, the 75, and you debit contribution. Now, sometimes students have trouble with what you debit contribution. Well, remember change in accounting estimate, which is what this would be. We thought they had a value of 100, but they don't have a value of 100. The value is only 75. Change in accounting estimate, FASB has told us, is handled prospectively. So you take that debit to the contribution in the period in which you realize the loss here, which is this $25. Okay, good. Reciprocal transfers, exchange, fees, they are considered unrestricted contribution. And again, we would report that all under the unrestricted, without donor restriction is a bit more really actually the correct term there. Okay. Any money that the not-for-profit pays for things to acknowledge fundraising, calendars, those sort of things, the cost of those is considered a fundraising expense. It would be down in that support service category on our statement of activities and would be considered fundraising. Okay. You could have what we call intermediaries, easy for me to say. So what happens? Good example of an intermediary is say, United Way, okay, what happens? If you give money to United Way often affiliates, frequently, on most part, affiliates itself with various not-for-profits. And then they give the money to other not-for-profit organizations. And other not-for-profit organizations like to get involved with United Way because they have a broader scope of potential donors by doing that through United Way's obvious position in the market and ability and recognition in the market. So not-for-profits will be willing to pay a small fee to be associated with say a United Way. So let's say you tell United Way, here's some money, but I want you to give the money, and you designate, they probably have a little online check that you can designate what not-for-profit you want your contribution to go to. Not-for-profit will say, who am I talking about? United Way will siphon off a piece of that, hopefully a small piece of that, but the balance has to go to the not-for-profit. Well, if you give that you've designated, well, if you give your donation that way, you have not given United Way variance power. You have told them who to give the contribution to, okay? Now, if it's a situation where you give the money to United Way and you say, United Way, give it to whomever you think in your network of not-for-profits you think is most deserving, then you have granted United Way variance power as to how to use your contribution. Okay, so let's just go ahead and take a look at how the counting would change if we're dealing with variance power versus not having variance power. So I thought this example was kind of useful, and you can see where the principles are talked about in the FASB. And if the money is given without variance power, remember, without variance power says, hey, I am telling you, give this money to this organization. Then the asset would be debited, say cash, and the recipient, the entity like United Way that you gave the money to, would set up a liability, maybe called refundable advance, and that they must give that money to somebody else. Now, what about the ultimate beneficiary, the one that you have told United Way, hey, give this money to that organization, say our little example, Save the Canines. Well, if you go over to the next page and you go down to item B, the beneficiary without variance power would be notified by, say, United Way, hey, contribution has come in your name, and they would debit the receivable for the money that's going to be coming from United Way, and they take the contribution revenue, and again, depending on the terms, either with or without donor imposed restriction. Now, if you give United Way, in this example, the recipient money, and you've granted them variance power, you've said, hey, you decide how to use it, they will report it as a contribution on their statement of activities, okay? And then the beneficiary, if you come down under number 2 here with variance power situation, the beneficiary would not recognize anything until United Way notifies them, hey, we have decided that we're sending you some money, and then they can go ahead and set up the receivable and the contribution at that time. Without variance power determines how that contribution, when it's given to an intermediary, would be accounted for. Okay. Okay, good. Again, we saw that all expenses are reported as without donor imposed restrictions, which I have used the old terminology here, unrestricted, on this slide. Okay. Okay, good. Accounting for investments. Investments are reported at fair value, and gains and losses on those investments are reported on the statement of activities. There is no such thing as the categories that FASB uses for bonds where they sit there and they say, hey, is it a trading security? Is it a held to maturity security? Is it available for sale security? And you get into all kinds of wonky accounting rules depending. For not-for-profits, everything is treated as though it's a stock. Fair value and gains and losses go straight to the statement of activity. Okay. And I kind of jumped what I was saying before I changed the slide there. That's what I just stated. Everything's treated as though it were a trading security. There is no available for sale or held to maturity treatment for any not-for-profit investment. Okay, so a few other things here. Split interest agreements is something that we'll talk about. Split interest agreement is when a not-for-profit is given some money and the donor says, I'm giving you this money, but I want you to do this with some of it, and that whatever is left, say in a charitable remainder trust, the not-for-profit can use. Okay, so I thought the best way to look at this was to have this little example here. Basically saying, hey, when money's given in a charitable remainder trust, whatever the money is comes in as a debit to the asset, liability for whatever the donor says you have to do with this money, and then the remaining amount is considered a contribution with donor imposed restriction. So I thought it was okay to sort of steal this example to drive home the point here. And we have this Albert Altruistic donates $200,000 to the Carbon Museum under the terms and conditions of a charitable remainder trust that guarantees Mr. Altruistic a lifetime tax-free annuity of $20,000 per year and bequests the remainder to the Carbon Museum for use in this operation. Obviously, this guy doesn't like his kids or his family, so he's decided I'm leaving the money to the Carbon Museum, right? So he gives them $200,000, and the actuaries figure out how long is this this nice person going to live, so forth, and says, hey, the present value of what we're going to have to pay him for $20,000 a year till he goes to the big not-for-profit in the sky is $84,250. So they set up a liability for that. You can see that I credited liability there, $84,250. Obviously, I debited the cash for $200,000. The difference would be the liability contribution with donor restrictions. And you're saying, well, why is it with donor restrictions? Well, if I can't use it right now and I have to wait for the person to kind of, die before I know what I can start to spend otherwise, that's a time restriction, right? And so a time restriction would constitute a with donor imposed restriction. So we would report it as $115,750 increase with donor imposed restrictions. So the correct answer would be number 4 there. Okay. Okay. Now, when we have assets like that 200,000 or liabilities like that, whatever it was, 115,000, whatever, those amounts would have to be separated on our statement of financial position as being associated with split interest agreements. That contribution that came in, that 80-something thousand, whatever it is, it would have to be separately listed, separate line item showing that it was a contribution that came in with a donor imposed restriction. Okay, and we saw the example where that we use present value or fair value if we didn't have a time situation where amounts are coming in over time. Donated collection items, and by the way, same rule that we talked about for government works for not-for-profit. Okay, so the not-for-profit, remember we said for government, does not have to show collection items on their financial statements as long as they meet all of the requirements. It's part of a collection that's held for public exhibition. It is protected and preserved, and the organizational policy is that if it is used, if one of those items is sold, the proceeds must be used to get other collection item works of art. Same exact thing we said for government entities, okay? Okay, that's all I have for our chapter 14 slides. Any questions on any of that? So what I'll do is I'm going to go ahead and conclude my comments there. I will take a look at some examples of not-for-profits next time. And let me do a quick thing here, guys. Sorry. There you are. Seeing what we have left, not a lot of time. Okay, good. So what I'll do next time, okay, I'm not going to worry about the specifics, chapter 15, 16. We've got the not-for-profits now. There's not a whole lot that is special about what colleges do. Yeah, I'm not gonna get into that. In healthcare, there's some very minor things that I think more of our time would be better spent on chapter 11 and auditing governmental organizations. And I think I'm going to give you some things as ways to measure their performance and whatnot. And maybe by then we'll have an example of a couple that we can kind of mess around with their financial reports a little bit. And then it's going to be on you guys here in a couple of weeks. So make sure you're coordinating with your team, okay, for our last day of class presentations. So we're getting short. Okay, guys? Questions?
So there will be group presentation and no midterm, correct?
No final, yeah. What we had scheduled as the final. That's correct.
Okay.
And thank you for asking. I think I have listed on the syllabus guest speaker write-up, do I? Yeah, you're not gonna have to do that either. There'll be no guest speaker write-up. Don't worry about that. I'll just give you the points for that. And I've given you the points for the first exam, the 100 points everybody got. And then the other 100 points that are listed under class examination will now be replaced by the presentation. So you don't have to write up the guest speaker. You do want to make your presentation with your group on the last day of class. Guest speaker was last week, right? You don't have to write anything up for that. Question? Does that make sense?
Yes,
Oh.
thank you.
Okay. Okay, guys. Well, thank you. And we will see you next week. All right. Keep up the good work.
Thank you. And Professor, can we use this Zoom link? Because we're
Yes.
just one, we have two who don't work for the city in our group. So,
Yeah, it's okay.
yeah.
Yeah.
Thank
Yeah,
you.
it's there for you. I mean, don't start hitting the record button and saying all kinds of inappropriate things, but use it responsibly. But yeah, that's fine. Okay. Okay, guys.
Thank you.
Have a good rest of the
Bye.
evening.
Thank
Thank you.
Bye-bye.
Bye-bye.
You bye.
So, let's see. Natalie's still here. Kathy's still here.
Yeah, I'm still here.
Oh, Apurwa?